Good afternoon, everyone. This is Von Bryant here with Foley and Lardner, and welcome to our CLE today, hosted by Foley and NBA, Commercial Law Section, M&A Transactions Bootcamp for non-M&A practitioners. And one more housekeeping point here, and to the extent you're not familiar, our team here at Foley and Lardner, we are a top tier AM Law 50 law firm with practices, pretty much in all verticals and industries. 23 offices across the United States, with offices also in Mexico City, Mexico, Brussels, and Tokyo. We here on the call today are part of the M&A team, but we all have practices that span kind of even broader types of transactions than that. And we would be happy to work with you and to talk with you on anything you may need. So I'll say one more thing about myself before I pass it to my colleague. So again, I'm Von Bryant, a partner out of our DC office. I'm in the M&A and venture capital practice groups. My practice is probably a majority of venture capital transactions, both on the company side and investor side, but I also do a fair amount of M&A and other types of corporate transactions. Excited to talk with you all here today and looking forward to just being helpful and being a resource. So now I'll pass it to my partner, Clyde Tennant, to say a few words about himself.
Thanks, Vaughn. Yeah, hi, guys. I'm Clyde Tennant. I'm a partner in the Milwaukee office for Foley. My practice primarily focuses on representing sponsors, so fund sponsors, but I also do significant work in capital markets, representing public companies, and also do a significant amount of corporate finance. And so really looking forward to presenting. And as Vaughn mentioned, this is really, we want this to be practical more than anything else. And so, stop us at any time, ask as many questions as you want to, because we really want to make sure that we're touching on the points that you have. You'll notice that we have a lot of content, and you guys will have, you'll have access to these slides afterward, and there's a lot of good information. But we're really going to focus on things that'll be kind of relevant to you. We want to make sure that this is, again, practical over everything. So, and then Steve, why don't you introduce yourself as well?
Hi, thank you everyone for joining this presentation. This is something that we've done in the past and we really enjoy it, and we really look forward to hearing from you all out in the audience today. Again, my name is Steve Cade. I'm a partner in our Chicago office for Foley and Lardner, and I'm also in the transactions practice group together with Vaughn and Clyde, where I specialize in M&A, both on the buy side and the sell side. I also do private equity transactions and venture capital financings. And I also work on complex commercial transactions. And so I do all of this in a variety of industries, including manufacturing, food and beverage, medical products, and consumer products. At the sake of beating a dead horse, I want to reiterate what Vaughn and Clyde said, that this presentation is for your benefit. So we would love to hear from you, and we want to know what you are most interested in. We have prepared a broad set of materials for your reference, and those will be available to you. And we'll certainly touch on a few topics during this presentation that we feel are relevant to the market. But it really is our strong preference to discuss topics that are of current interest to you, that, frankly, might be keeping you up at night. So please do use that Q&A feature on this platform, as we love to start a dialogue. I believe most of the folks who are RSVP'd for this session are in-house, so it is likely that you may have some questions that others are interested in, so do not be shy. Just a high level, the agenda today, we'll start with a quick market check, and then Vaughn will give us an overview of the acquisition process and timeline. Then Clyde will discuss valuation metrics and issues relating to how purchase price is determined, and also the various transaction structures. Clyde will then also touch briefly on due diligence, and then I'll close this out with some considerations relating to purchase agreements. So as I mentioned, the hope is that, we do not make it through this agenda and all these slides. We certainly won't. But again, we're hoping to discuss specific topics that are of interest to you. So feel free to chime in with your questions at any point during this presentation. Okay, so we thought it would be a good idea to just give a brief update on the M&A market and what it's looking like now and what it's going to look like in the near future, based on what we're hearing in the market. So in talking to your M&A colleagues or others who do M&A transactions, you're likely aware that the M&A market was very hot the last several years coming into 2023. With that said, M&A activity took a bit of a downturn with the economy, and the volume has decreased pretty substantially since last year, and almost 10% since this time last year, and that's really due to a number of factors. One key factor is really the pricing of the deals, right? During the high time in the M&A markets, EBITDA multiples were pretty high, right? And EBITDA multiples, is a common way to value companies and determine purchase price. There's a number of ways that you can get the purchase price, but profitability, net income, revenue, and some sort of multiple on that is usually the most customary ways in which we've seen purchase price being determined for M&A transactions. And over the last few years, particularly coming out of the recession, those multiples have been pretty high. Now that the market is softening a little bit, the multiples have come down some, which at least from a financial seller perspective, like your private equity firms, your VC firms, that's not as attractive, right? They obviously want to maximize value. Same thing for our strategic clients as well. But I think because of the softening of the market, a lot of folks are kind of holding off on sales until maybe some of those multiples increase. I also think another key impact on M&A activity has been a very, very challenging financing environment. A lot of lenders have increased rates significantly, and as a result of the tough financial market conditions, we are seeing purchase price, essentially being financed through sellers, via seller note, which allows the buyer to essentially pay the purchase price over time. Also, we've seen the rise of earnouts. If you're not familiar with an earnout is a commonly used tool where buyers and sellers bridge gap in the purchase price. For those who are not familiar with earnouts, an earnout is a concept that that we've seen employed over the years, and we typically see it employed when the market softens a little bit. I currently actually have 2 deals right now where a significant amount of the purchase price is subject to an earnout. One is tied to revenue, and the other one is tied to EBITDA. And so they track those performance metrics post-closing, and then a lot of the purchase price is paid out post-closing instead of at the closing table. On this next slide, I want to highlight, this first bullet point, which is that we still assume that there is still going to be a modest recession in the first half of 2024 that will likely impact M&A activity. Inflation is still high, and we expect the Fed to raise rates at least one more time in Q1. So the M&A market, at least going into the first quarter of 2024, is still a little bit unpredictable. We don't know what's going to happen. I mean, listen, deals are still getting closed, right? The market has been pretty uncertain this past year, just given the rise in inflation and the tough, financial and credit markets. But deals are still getting done. So even though we think that the market will be a little bit soft, I think you'll still see plenty of activity. On this next slide, I think of particular relevance to our in-house partners is that fourth bullet point, where we are seeing more activity from strategic buyers, and particularly strategic buyers that have strong balance sheets. As I mentioned earlier, private equity firms are generally waiting for better terms, particularly for dispositions, and they also tend to rely on credit markets to help supplement purchase price and the financing of purchase price. So we're seeing a lot of strategic acquirers, which are basically non-financial firms, acquiring businesses because they have a lot of cash on the balance sheets. So I wouldn't be surprised if you're going to be pulled into deal support or hearing more about deals being closed at your respective companies, because a lot of companies have been executing a growth by acquisition strategy. And then on this, so we talked about earnouts and seller notes and seller financing. So I'll skip to the next slide. On this side, I just want to briefly talk about rep and warranty insurance. We'll talk a little bit more about this later on, or even now if folks have specific questions. But we are seeing a lot of rep and warranty insurance products being utilized on deals. Rep and warranty insurance has been around for a while now. It certainly has become very popular over the years. And for those not familiar with rep and warranty insurance, it's really where a third-party insurer will indemnify or cover buyers for losses relating to a breach of a rep or warranty by a seller. Like I said, it's an increasingly popular product for buyers and sellers to use, and it has a ton of benefits on both sides. One significant benefit is, it takes away the time period and the contentious negotiation of reps and warranties throughout a deal, right? So a lot of the risk is now taken off of the sellers or the buyers. It's placed in the hand of a third party insurer. So it's rare, that I do a deal that is over, let's say $30 million that does not have some form of rep and warranty insurance. And I've seen deals even, closer to 20 million get rep and warranty coverage. I would say when the market was really hot, post pre-pandemic, and then the first 6 or 7 months after the pandemic, the rep and warranty insurance was utilized a lot, and the insurers were very, very busy. So it was hard to get good terms on those. Premiums were high, retentions were high, just because it was such a popular tool. Now that the market softened a little bit, we're now seeing better terms from the brokers and the underwriters and the carriers to procure these products. So it's something that private equity and financial firms have used for years, but we're definitely seeing a lot more activity from our strategic buyers and sellers with respect to rep and warranty coverage. So I don't know, Vaughn or Clyde, if you guys, what have you been seeing, with respect to rep and warranty insurance? I think this is a point that we should probably spend some time on. So if you guys have any additional thoughts, I'd love to hear from you guys on this as well.
Sure. One point, Steve. Kim Bush asked a question, so I just wanted to answer quickly, at least from my experience. She asked about, are there deals more prevalent in any sort of particular markets or industries? And I would say that in general, yeah, I'm seeing a lot of activity in biotech space, a lot of EV related stuff. So any kind of tools that are for the electrification is really hot. Other life sciences, sort of broadly speaking, and then fintech, I'm seeing a lot of, there's still a lot of prevalence there. As Steve mentioned, the multiples are still high. Financing is not great, but this is, this is an opportunity for a lot of companies to sell, and so they're taking advantage of it. Steve, to your point about rep and warranty insurance, you're absolutely correct. The terms have gotten significantly better, and it is sort of widely available. A couple things to kind of level set. So in private equity, I saw a stat that 75% of deals all have rep and warranty insurance. So you'd almost certainly going to have it. But even strategic deals now, it's up to 64% of all deals have it. As Steve mentioned, there's sort of a couple different things that kind of go into the pricing of it. Initially, when you kind of get an indication, it really doesn't cost you anything to get that. But after you get that stage, after you have at least sort of a quote, if you will, the companies will usually charge you about $30,000 or $40,000 for due diligence just to kind of look at the deal. They do actually have to read the purchase agreement, understand what the deal is and what sort of risk they are insuring against. The pricing is typically right around 3% of the coverage of what you're getting. So, for example, if you have a $200 million deal, and the seller is retaining $20 million worth of liability. So if one of their representations they make is false, and there's a payout that's required, they may have a cap of let's say for example $20 million of what they have to do. So for an insurance policy, 3% of that is typically what you can expect to charge. They're typically not going to charge you a premium less than $100,000. So, you can kind of do the math to kind of figure out whether or not economically it makes much sense for you to do it if it's below that point. And the other sort of key point is what we call retention, which is kind of like a deductible for insurance. And so and whenever there's a policy, they do want the parties to kind of have some vested interest in actually kind of, in an arm's length transaction. And so what that basically means is that for the first, usually 0.75 percentage points, so 75 basis points, the seller is required to actually pay any kind of indemnification claims for that piece. And then after that point is when their coverage kicks in, and the insurer will then pay the buyer for any indemnity claims made after that point in time. But those are kind of some key aspects that I see right now.
Yeah, absolutely. And, I think, Clyde hit it on the head, particularly with respect to the pricing, the insurers, the brokers, the carriers, underwriters, I think they all are, open to negotiation. I think, when we saw the height of M&A and, end of 2020 and 21, the terms were kind of take it or leave it. But now we're seeing a lot more flexibility on the terms. And frankly, if you're working on an M&A deal, particularly if you're an in-house counsel, talk to folks that are in your risk management departments, because they maybe already have relationships that are already established with brokers and carriers, in which they could probably get, better terms on those products as well. So, and one other point to Kim's question about, what are the prevalent markets, where M&A activity is more prevalent. I'm also seeing a lot on the consumer product space, which is, can be kind of broad, but, with respect to, manufacturing products, with respect to other consumer products like, fashion and beauty, even in this market, I'm seeing a lot of activity, because I think there's a lot of these companies that need either rescue capital, or they're looking for, a strategic transaction to take them to the next level to help them scale and grow. So, it's just, it's a lot of different industries for a lot of different reasons. So, with that said, I'll turn it over to Vaughn, and he can talk to us a little bit more about just the general acquisition process. But please do feel free to come, with more questions.
Thanks, Steve. And to add a fine point to Kim's question, and this may be anecdotal, but a lot of the deals that I'm working on right now are focused on AI, cybersecurity, and telemedicine. So again, just in terms of innovative technologies, you have a lot of investors, at least on the venture and private equity side, that want some part of their portfolio invested in an AI tech-enabled platform or company. Like, they don't want to miss the AI boat. Cybersecurity, kind of self-explanatory why that's ever increasingly important, and kind of a good play for investors and acquirers alike. And then on the telemedicine side, during and post-COVID, really fundamental changes into the way that healthcare is provided, across state lines, via video, kind of a lot of, how things are prescribed, just kind of longstanding rules have changed, which has opened up opportunities, depending who's at the table. So, as deal lawyers, we're going to always rally the market and be up on the market, right? And talk about what we are seeing. And so those are some of the things that I'm seeing. And echoing Steve from earlier, one of Steve's earlier points, I'm seeing big earnouts where, the cash on the table is less than, at closing, is less than the aggregate deal value, which is like loaded with earnout. And then if I'm representing the seller, so you got to be comfortable with cash at closing, because there's, a million ways to kind of negotiate, kind of set up a structure that is not advantageous to the seller to achieve those earnouts if the right provisions aren't in place. So
I hate earnouts. When I'm representing a seller, like I hate an earnout. And like Vaughn said, I tell my sellers, clients on the sell side, don't expect to get much, right? Unless you're literally running this business and you have flexibility that's written to the contract. It's really a subjective metric. So great for buyers, I think less great for sellers.
Agreed. Transitioning to the acquisition and timeline phase of the deal. And so the timeline is going to differ on the size of the deal, the industry, whether or not there are regulatory hurdles, HSR, or in the healthcare space, transfer of licensures, depending on what the space is, there may be a regulatory component, which will kind of tack on additional time prior to the closing. But if you think, $1 billion deal, that could take a year, $100 million deal, 3, 4, 5 months, a middle market deal, less, $50 million deal you can do in 2 or 3 months if everyone plays nice, and this is going from kind of like LOI to signing or signing and closing, depending on the structure. But it varies, but it's a meaningful amount of time. And the role of in-house counsel, at least most of the in-house counsels that I work with, for the GC wants, outside counsel to keep her up to date at, more information that matters. You let her decide what she wants to bring to the board or to the rest of the C-suite, but just kind of, having, our pulse on the deal and communicating that in the way that the GC wants to digest or the deputy wants to digest that info so that they know what we're doing. They're not doing it, but they're up to date, because the business folks, your colleagues are going to come to you and say, where are we at? And you want to easily know, right? And so we spend a lot of time up front developing checklists, developing timelines, all of that kind of front end organizational project management work where the in-house team is really involved, pays dividends throughout the process, because it keeps everybody plugged in and organized to kind of get where we want to go on time. Go to this next slide here. So you want to, clearly have the goals and objectives, established when entering into the transaction. You'll hear the word synergy all the time. And I like to think of synergy as 1 + 1 = 3, right? That's a good deal. If we can kind of create value, unlock value through the sale or the acquisition, as the case may be. Understanding the key risks, that's going to differ deal to deal, industry to industry, and the in-house team. You can save the day by just kind of highlighting. If you're the one that understands the key contracts that require consent to, for a change of control, or if you're the one that knows that license in Texas, we need to have the correct party on the reapplication, or there's going to be some gap and we can't do something. We as the legal team, outside we have our transaction role, but inside you guys know the company inside and out, and will be looked to provide that guidance, throughout the process. You're going to want to communicate the goals and objectives up front. Everyone should know why we're doing, why the company is doing what it's doing. Is it to add new capabilities, to expand into a new, geography, diversify the business, whatever the case may be, that should be clear, because as you go through the diligence process, if something starts to become untrue, maybe you have to walk away, but hopefully by the time there's an LOI, the business teams have gotten comfortable and we're ready to do a deal. So kind of touched on some of the reasons for the acquisition before. And, again, this isn't something that's necessarily documented, but just kind of internally, you want to be aligned on why you're doing what you're doing, and it'll help kind of maintain progress when there's a lot of moving pieces, there's a lot of work streams. You need to remain focused on the goal and why you're doing what you're doing, to continue to level set that it remains true.
As Vaughn said, some of these things should never be documented. So the second and last bullet is a very real reason that a lot of deals are done, to eliminate a competitor, but you never want to have any document like that states that, because that wouldn't go over well when you go to the Federal Trade Commission or the DOJ and they're looking at a deal. So being mindful of that is really important.
Agreed. And in phrases I've seen in SIM's confidential information memorandums, we will dominate the market. Like, whoa, like things like that are not helpful and could actually be, just impermissible depending on the context and how you're communicating that. So you work with outside counsel to kind of scrub all of those types of materials to make sure that they're appropriate. And then additionally, we can add disclaimers at the back end. And if there's an investment banker, they'll have a set of disclaimers, but just things that you've likely seen before, but they matter. Like, this is not an offering. You need to do your own independent due diligence. So there are disclaimers that you want kind of tacked on to these, the materials that are being circulated. So exactly, eliminating a competitor, you kind of, I would not describe it that way, but you see a lot of tech companies kind of R&D through acquisition, right? A new functionality or a new capability, just buy the company that's doing it, and then like now Big Tech Co can do that too. So you kind of see that growth strategy deployed often. So these are some key bullets of typical reasons for an acquisition. So identifying the acquisition target. So that's going to be the business team, and they're going to evaluate things such as the market, the products, services, customers, vendors. Where is there a competitive advantage to be had, through the proposed transaction. And I've touched on some of the kind of related points here with geography or capabilities. These are all the same things that the business team is going to be evaluating on when they bring a deal to the table. The financial considerations, again, something that as in-house counsel you want to be familiar with and understand at a high level, but that's going to be the accounting and business teams that own, what is the multiple that makes sense, and then validating that multiple. Sometimes you have an outside firm do a quality of earnings, things of that nature to kind of get comfortable that the business is as you think it is before you acquire it. Things around margins and customer supplier concentration makes me think about confidentiality, trade secrets with things like pricing and if there's discounts. And you want to think about as the transaction gets started, maybe you phase how you provide the access to the information. Maybe you hold back sensitive things like pricing or, on the intellectual property side, if there's a trade secret, or certain code that's not copywritten, you think about how you share those types of materials, and we can set up, or you can have set up processes to kind of put the evaluation of certain sensitive materials in the hands of a third party, right? Or having so-called clean rooms and kind of limited access. So you really want to, all this information, if you're the target, you ultimately will be required to share, but you should be cognizant of how you share it and when, and make sure that you have some deal certainty before you show, especially a competitor, your secret sauce. So timeline, at a high level, I touched on that at the outset, and it's going to vary. But I would say your typical deal, it takes a couple of months, and then if there's HSR required, you need to tack on another month or so for regulatory approval. And, if you have a cross-border transaction, there could be additional, regulatory considerations, or if there's a public company involved, there's different filings and notice periods. So just depends on what you're doing, but you want to have a clear understanding in the beginning. How long is it going to take? Because what folks don't like, no one likes surprises. If you think it's going to take one amount of time and you get close to the end and you realize it's going to take additional time to close, people are going to look to the lawyers, rightly or not, to kind of, why didn't we know this ahead of time? So the timeline in the sales process is going to be key. So starting the sales process, there'll be typically a teaser, a short document, a longer confidential information memorandum, which you'll hear referred to by the acronym, the SIM. These documents should be prepared in conjunction with in-house counsel, for some of the reasons that I mentioned previously, but also for securities laws purposes to have appropriate disclaimers and to not use inappropriate language. There'll be management presentations. I see a lot of times, the top lawyer at the company may get invited to those, but oftentimes the legal team's preparing the management team on how to conduct those meetings and kind of think do's and don'ts, getting them ready for those negotiations. And then coordinating the transaction process. So I like to think about it as, the quarterback or the point guard in sports kind of running things. You can't do it all alone, but you're kind of responsible for making sure that things get done. And, in-house counsel, that's going to be a large part of your role in an M&A transaction. So you want to have kind of clear leaders for, different subject matter areas, depending on the size of your company and the size of the deal. But to the extent, different people or groups can own, parts of the deal. The benefits team, you guys evaluate how we're going to onboard the employees, and what are we doing with the existing 401k plan. And like, there can be a lot there that like the quote benefits team should own. And then there'll be, the kind of general corporate due diligence on the capitalization of the company, kind of the fundamental representations. Are those accurate? What do we have as backup? And the more you can slice and dice and have a team and not just be following one person, you're going to have a better chance at staying organized, getting things done in a timely manner. And then that's also where your outside counsel, we have those capabilities. Like, we have all of those groups. Put it on us, and we'll manage it and keep the in-house team up to date in a helpful way. You'll of course identify your stakeholders. One of the early things you see in a deal is the deal team, the transactions list for all the relevant parties that are involved, and their emails and where they're at, what time zone. And you end up needing that, especially in crunch time. You need to get to a certain group. You want them to be easy to find. You want everyone to have everyone else's contact info. And then if you're dealing in manufacturing, or there's a factory or something, there may need to be environmental assessments and phase 1 reports or phase 2, and those things take time. So early on in the kind of planning part of the deal, you want to identify those kind of long lead time items that take weeks or a month to do, like an environmental report. So you want to know if you need that earlier on, so you're not missing something when you get closer to signing and closing. The confidentiality procedures, one kind of fun thing about a deal is you get a code name. And I've had code names, from like movies, Top Gun, and, ones that are just acronyms of the parties. So you got all different types of deals, but you would refer to the code name so that there's not hundreds of emails describing the parties, right? You want to have kind of code name for the deal, and you can even have code names for the buyer and the seller, so that, the correspondences can be somewhat muted on identifying and trying to hopefully minimize the opportunity for a leak. But, leaks happen on the bigger deals. And in that case, the company you're in, not, I hate to say crisis prevention mode, but kind of real time live, all hands on deck. How are we going to respond? And if you're a public company, you have securities laws, considerations like immediately. And that you need to evaluate all of that, come up with your best strategy to, cool the waters, deny if possible, but keeping the securities law framework in mind is something that you'd have to work with, outside counsel to have that strategy. Establish a timetable. We've talked on this. There would literally be a timeline, and that's what you'll measure against for deliverables. If something's late or early, and it's fluid, it's updated at least weekly, but you're going to have a timeline and a timetable to kind of manage this process. Whether it's $50 million or $1 billion deal, they're all going to have timelines and transaction checklists. Managing the acquisition team, same thing, related to the previous points. That's the role I often see in-house counsel take, is kind of managing us and letting us know what are the key priorities for the business team. And then that's how we can prioritize what we're doing to make sure we get you what you need, when you need it, and that it's helpful and a digestible deliverable that you can sign off on and send to your colleagues. So kind of, we know that's our role, is to help you manage the deal. And so that's one of the key things that we do as partners working with our clients. So the role of the in-house lawyer, again, setting the deadlines and the expectations, managing the budget. I mean, absolutely. And M&A, I would say is probably the toughest kind of type of transaction to do a fixed fee, let's say, because you just don't know. And if there's an investment banker involved, there'll be points of the deal where it's 24/7, and you just don't know how many of those instances there'll be on any deal. But there'll be periods where there's 4 or 5 people around the clock trying to get something done, and so that can blow a budget. But we try to have, try to build that in, but it can be unpredictable. But we get it. You as in-house counsel, you need as much certainty as you can. You oftentimes get a set budget up front, and then you try to back us into that, and that's what we want to do. We want to be helpful partners, but the budget is really can be unpredictable in M&A. Identifying business issues that can impact the legal terms. So like that's where we really add a lot of value as a firm, and then you as the in-house team to the business team. That's what folks want to know. What are the things here that they may be missing on, data privacy and sharing customer info. Like there's so many things that, it can't just happen at the drop of a dime, that require planning and strategy to ensure are done correctly and on time. You as in-house counsel will, again, be the interpreter to the business team, interpreting the information you're digesting from us, and also kind of, putting legal speak into quote business speak as you communicate, and keeping everyone up to date and progressing through the transaction. And there'll also be lots of coordination. I touched on this, but depending on the type of deal, there could be a dozen subject matters that are relevant, including tax, real estate, finance, employee benefits. I mean, most companies have employees, so employee benefits is pretty much part of every deal. Just kind of asking us questions to ensure you understand, so then you can be the best, most effective communicator to your business team. All right, Clyde, that was the last one. I'm gonna pass it over to you.
Yeah, so all really, really key points. And one thing we always keep in mind when we're working with a client is that you guys have day jobs, besides, so there are often lots of other priorities that kind of get pushed to the side. And so we respect and appreciate it. And like you said, we provide, timetables, et cetera, mostly for the benefit of, again, the internal deal team, as well as all the other specialists that need to be involved, because asking people to drop things at a drop of a hat to kind of jump into the middle is really difficult. So we're going to talk a little bit about valuation issues. It's, as a lawyer, it's probably easy to think a lot of the valuation issues as being someone else's problem. A lot of times you'll have financial advisors involved. Obviously, you'll have accountants involved, et cetera. The board will have those views, but there are a lot of things that overlap with us. So just kind of to level set and talk about sort of just in generally value, when we talk about either enterprise value or equity value, we're really either talking about the enterprise value, meaning, all the assets as well as the liabilities together. So, what the debt, et cetera, versus the equity, just sort of what's the equity value worth of that company. Typically, you're going to be looking at backwards looking to figure out multiples. So you might have heard Steve mention before, multiples at 8 times EBITDA, earnings before interest, taxes, depreciation, amortization. That's a proxy for cash flow. And so when a business says, okay, I'll buy you for 8 times, basically, essentially what they're saying is, okay, I can expect in about 8 years, I can pay off this. I'll pay the purchase price over that time. And that's a very common way of doing it. Obviously, if you have a business that is pre-revenue, right, then that's not going to be a very useful metric. So then you're looking really at projected revenues. What do we think this business is going to be doing in the future? In either case, it's really, really important that the folks that you're working with kind of understand what's our goal in either acquiring this business or selling it, and how are we kind of arriving at this when we engage other parties, whether it be investment banks or otherwise, to do it. How are they actually doing this? Are they looking at other sort of participants in the industry to kind of figure this out? So if we want to go out with the 8 times multiple, but no one in our industry has sold for more than 5 times in the last 10 years, that's probably not going to go over well. If you're representing someone who's a seller, it's going to be really, really critical that your board will ask you a lot of questions about sort of, again, how do we come up with this number? How do we, do we go through an auction process to figure this out? How are we certain that we're actually doing this at the right price? Again, what is this business worth? Common issues that come up is, again, in most deals, when you buy the company, you're buying it on a debt-free basis, meaning that you expect, if the company has $10 million of the debt right now, when you close it, you want them to pay off that $10 million debt at closing, or you'll pay them if you're the buyer. And so we really want to see, we're also going to expect that the seller, is going to take any cash that's in the bank. So any cash that's in there is also going with it. So we're not going to get that benefit of that. And what does that mean ultimately when you're doing a deal? Because very often you're buying a business that's a going concern and is operating day to day. Every day they're selling something, so that means that they're getting more accounts receivable. Every day they're agreeing to buy more supplies from someone, so that means they have accounts payable. And so because there's all this flux and everything, we very often have to do post closing purchase price adjustments, basically to make sure that the seller gets the consideration they were hoping to get, and the buyer gets what they were, on the basis that we have a mutual understanding about what actually we're buying and how we're buying it. And so that can really make a very meaningful difference. Value also plays in a lot when we're kind of figure out sort of leverage. And so if you are a buyer and you have an existing credit facility that says that you are allowed to have, you must comply with certain financial covenants. So, for example, you have to have certain, your income has to exceed your interest coverage ratio on a certain basis, or you're not allowed to have more than a max amount of leverage, meaning that your debt can exceed your last 12 months EBITDA by a certain ratio. It's going to be very important that if you're on the team that runs that you understand, how does this fit into it? Are we going to need to go to our lenders to get special consents for us to do this deal because this doesn't fit? Do we need to adjust any of those covenants to make sure that we have some sort of period of time that we're not, the minute we buy this company, we're not under the gun right away? For those who are not in M&A or not in the traditional practice, or understanding sort of contingent liabilities is really a very important piece. And so if you're in litigation, you may be asked to look at ongoing litigation that the seller is going through, and how's this going to impact the financials for our company going forward if we buy this company. What are these contingent liabilities are out there that again, they haven't surfaced yet, but they're out there. And so how do we build that into the value? For the last few years, we've dealt with a lot of volatility, meaning that there's been cash flow, kind of going up and down. There's been sort of huge peaks. Many businesses had, suffered horribly during COVID, but on the other hand, there were many businesses that did spectacularly well. And so one of the things that many companies now, both sellers as well as buyers, are looking at is getting quality of earnings analysis. So they're actually looking at the numbers and seeing, is this actually a very real number that we're looking at? So when we're doing all this evaluation, trying to figure out how does this work in with our ultimate plans, can we really rely on these numbers? It's also sort of, again, really important that we understand, particularly if you're a public company, when you're acquiring a business, you have different reporting obligations that are triggered based upon the size of the business and the acquisition. And having all that information identified early and done correctly is going to be really important. Understanding key customers and concentration, again, is a very common issue that if the business team hasn't considered it, it's certainly important that you bring it up and really kind of have those conversations with them, because no one likes surprises after the fact. It's much easier to negotiate on price up front than it is to try to figure out something in the back end that we just really, we didn't take into consideration. We talked about earnouts quite a bit, and that's certainly kind of a reality in most deals, as Steve said, and I agree. Try to discourage it, but it is a way of sort of bridging value, having these earnouts, having this right to get additional consideration based upon the company hitting certain hurdles. But again, defining that carefully and understanding what that means, again, as a buyer or seller, is really important. And then also, again, all the other sort of non-financial factors, intangibles, business goods, et cetera, really important stuff. And talk a little bit about structure. As in a lot of things involving most deals, tax drives a lot of other things. But I think it's really important that regardless of whether or not you're a tax lawyer, that you kind of understand some very basic principles about sort of how deals are. For the one category, there's sort of three basic categories: the asset deals, stock deals, and mergers. In an asset deal, the buyer is buying very specific assets. So, getting certain equipment, they're buying certain facilities, they're buying certain intellectual property, whatever it is, there's a list, and they're actually buying those. In most cases, they want to buy those assets but operate them as a functioning business afterward. But you're buying discrete assets that are going to be agreed upon between the buyer and seller. Sometimes that'll require third-party consents, and again, very often you may have sort of specific asset transfers. So, for example, if you're going to buy or sell a plane, there's a whole process that you need to go through the FAA to have that particular asset transfer, and you want to make sure that happens correctly. The positives about this, again, for a buyer, is that typically then you know exactly what you're getting, and you also know that you're not assuming any liabilities. At least that's the goal. And so you really, you know, again, for in most cases, there's an acronym, BASS, BASS. Buyers prefer asset deals. Sellers prefer stock deals in general. So that's one takeaway. And so buyers like asset deals because, again, they know exactly what they're buying and are not assuming any liabilities. Um, there are some risks to it. You might leave something off the list, and if you do, too bad, so sad. That's really on you. You may still be susceptible to liability as a successor. So under certain state laws, if you buy, you know, if you basically buy all the assets of a company, irrespective of whether or not you've assumed those liabilities in writing, there are some certain statutes that by law say, okay, you bought all the assets, you know, you have to take the liabilities with it as well. And so we want to be very mindful of that and structured around that, you know, to the extent that we don't want to assume those liabilities. And again, the process of just identifying all the assets we buy can be a lot of work. Basis comes up again. Most taxes issues really, it's, again, a lot of structuring on deals is really related to tax. And basis is this concept that you're going to hear a lot about. Basis is basically, you know, it's like your starting point. So whatever you typically buy something at is typically going to be your basis. And so when you buy assets, your purchase price becomes your basis of the asset. It doesn't matter if your seller bought them 20 years ago and they paid they paid $10 million. Or you're buying them today at $100 million. Now you have $100 million as your starting point. So if you later sell those assets, you're only going to pay taxes on the gains above $100 million in that example. And so again, buyers do like to have that step up. They call it a step up in basis, meaning whatever they paid the purchase price, that's their starting point for their analysis as a seller later on down the road. In a stock acquisition, as the name might suggest, you're just buying stock. So you have a discrete entity, and you're usually buying whether it's the actual like stock for a corporation, or if it's LLC interest for an LLC, or partnership interest. In all cases, they're typically all viewed as equity or stock acquisitions. The entity that you buy is going to now usually become a subsidiary. So they may just stay as a standalone subsidiary, meaning that you buy them. So if you're ABC Co. and you buy, Google.com, you buy Google.com, and it just goes and it now becomes a new subsidiary. You could also merge it into one of your other entities if there's other reasons that you want to do that. But essentially, you're getting everything that company owns and also all its liabilities, although that's discrete into that one box that you've now purchased. If you have a seller where you're buying less than all the equity, so in most cases you want to buy 100% equity. So you buy, every seller. However, if there are cases where there might be, say for example, an 80% shareholder, but there may be lots of smaller shareholders, there are some benefits. If you get over 90% of the shares, then you do what's called a short form merger, and you can just merge that into another entity and not worry about it. Let's see. It's a question from Alan. Absolutely, the slides will absolutely be made available. So we definitely want you to have these, especially since we're going through them at this pace as well. With stock acquisitions, so the base is inside of the company. So if you buy a company and it has assets, in my example before, that has assets of $10 million, you buy the entity, those assets keep their basis at that low level, at $10 million. So if you later sell the assets, now you have what's called like built-in gains. I mean, that when you sell it, it's almost a virtual certainty when you sell it later down the road that you're probably going to sell that and have to pay taxes on that gain. Your basis in your stock that you purchase is what your purchase price is. So that's great. So if you want to sell the whole entity later, that's not an issue. But where the issue comes in is if you want to sell discrete assets after the fact, that's buyer. There is a code section that does allow you to kind of treat stock acquisitions as an assets purchase. So you want to be mindful of that, and your stock advisor will advise you on that. The last bucket is sort of mergers, and so mergers are just a function of state law. Two entities become one, and there's more than we could talk about it, but essentially when those two entities merge, all the assets and liabilities of both entities are now reside with the entity that survives, the surviving entity. There are a lot of tax circumstance where this makes sense, but again, this is actually probably the least likely you're likely to see. Most often, transactions are structured as asset sales or stock sales, but it is important to understand that mergers are also a possibility. Typically, you're going to do that for tax purposes, or in the case as I talked about before, if you're not able to get 100% of the stock, you can do a merger usually by majority consent of the selling shareholders of that company. There's two types basically. There's usually a forward merger or a reverse merger. In a forward merger, the target, so the company you're buying, that one's going to roll into one of your companies, and the opposite shoe is chopped for a reverse merger. So your existing buyer company or entity, it's going to be reversed into it. So but they have very significantly different tax treatment. So again, it's really important that you talk to your tax advisors when you're structuring these transactions. And then again, there's, based upon structuring, it could be, again, very distinct differences in how you get the treat for later sales. And so it's really important that you talk those through with your tax advisors. Due diligence. So part of every deal is that the seller knows more about the business than you do as a buyer. And so we're really trying to cure for two things. We really want to understand enough about the business that we close that gap, that information asymmetry, that we know at least enough that we feel comfortable that we should be buying this asset. And then secondly, we also want to understand enough that we want to be able to integrate this business, afterward and be able to also allocate risk appropriately between the seller and the buyer. There's a lot of diligence that goes into structuring a transaction. So, when we talked about structuring before, knowing what the basis is and the assets are, understanding sort of pricing models, et cetera. There's just a ton of information that's really, really important to do. It's this part of the transaction that's probably the least sexy, but possibly the most important. You understand sort of what consents are required. Understanding opportunities, synergies, risks. Sometimes there are risks that the seller is not even aware of that you unsurface as part of it. So it's really critical. I'll tell a very short story, but I had a client that sold a business. It was a very successful ongoing business, and as part of the deal, they made a representation saying that this business and the facilities are all in compliance with every law that's required to be that they're required to be in compliance with, and they thought that statement was true. However, 2 years before they closed, they had a contractor come in to look at their electrical system. The contractor looked through it, made his valuation, said everything looks great. It complies with all the laws that were in place 5 or 10 years ago. But if you were to operate this business now, you need to do all this retroactive changes to the building. That was sitting in some file cabinet. My client sold the business, and then 2 years later, got a call from the seller saying, "Ha, you guys, this business is not in compliance with all these different codes, and we want you therefore to write us a check under the indemnification provisions because you should have known that this building was not in compliance." So again, this was actually a due diligence exercise that as a seller we should have been more aware of sort of what, again, before we made that representation, we should have had a very clear idea that we could say that statement without having any concerns about it. There are certain things that are really kind of tough to deal with. Vaughn touched upon a little bit. If you are in a competitive situation where you're looking at acquiring a competitor, having access to data, certain pricing information, customer concentration, even capital expenditures can be a huge competitive disadvantage. So again, while it's super important, there may be other antitrust or other limitations to you getting what you need to. But ultimately, I always say as a buyer, it's really our duty really to push as hard as we can to get the information we need. And if we're not getting any information, it's really the seller going to have to justify it pretty critically. If there's intellectual property, what I see in a lot of transactions now is intellectual property is so important, such an important asset class, and very often there are people who have been working for the company for years and they don't have proper assignments in place. And so again, getting your hand on those things is really, really important. Understanding with real estate, understanding whether or not there's sort of easements, et cetera, that are applicable, whether or not there's covenants that run with the property, so it can only be used for a certain purpose. These are all things that need to be that you want to discover before you sign the dotted line. And as I mentioned earlier, really, again, really important allocating risk. If it's really a seller's issue, then they really should fix it before you buy it. Is really the bottom line, and making sure that these reps and warranties that you're making, again, as a seller, that they're actually correct. Your accounting team will also want to do some accounting due diligence. You want to very often, again, have quality of earnings from an outside party to look at the earnings to make sure that the numbers do make sense and they tie out correctly. And again, when you're acquiring a business as a public company, if they're over a certain size, you're going to need to actually report some of their financial data. So it's really important that the numbers are correct, because you have to report that information on a timely basis. And there's not enough time post-closing to kind of make sure that the numbers are right. And once those numbers are incorporated, they become part of your numbers as a public company. So if they're wrong, then naturally shareholders can sue you, because you now put out these wrong numbers, and it's not a good look for anyone. So it's also critical for your board that they feel assurance that what they're looking at is correct. The legal due diligence is really, really broad, and really your role is critical to touch upon different areas. There are just things that lawyers think about that others in the business are just not going to be thinking about. And so we've talked about some of the special areas, but it's very, very important that we have eyes on these documents and what they say, and understand, again, big picture, we're ultimately, what are our goals, and make sure that we're actually going to achieve those. The business due diligence, as you might expect, is really sort of on the deal. But again, everything we do goes hand in hand with what they're doing. So we want to be an ally to our business partners and make sure that they're actually making good decisions and have the right information to make good decisions. Negotiating LOIs, we're going to very lightly touch on these. This is usually after you sign a confidentiality agreements. One of the very first stages actually we sort of throw out proposed terms for a transaction. Most often it's going to be the buyer that's going to throw out proposed terms, and they're going to have, obviously the purchase price being a sort of a critical term, how much cash they're going to have at closing, whether or not they have finance contingencies, whether or not they're going to set up an escrow. So whether, they don't. Buyers in general, when you buy a company, your exclusive remedy is to actually seek indemnification, other than rep and warranty insurance, as we talked about. So meaning that when you buy this business, it's yours, and there are no refunds. It's not like buying something at Costco. You're really on the hook. It's yours. And so the indemnification provisions are usually, again, really highly negotiated, and escrow. The buyer may require that the seller put part of the purchase price aside in an escrow account to cover that potential liability for a certain period of time, until it lapses. And finally, sort of employment and consulting agreements are usually pretty important to at least contemplate. You may have non-competition agreements concerns. This is an area that's constantly changing now in the law. We're under state and federal law. There are very limited circumstances where non-competes will be enforced, and so it's really, really important that you kind of have that discussion with both your external advisors as well internally. People understand, there's a pretty good chance that our sellers might be able to go out and go into business afterward for themselves, and that obviously should affect the price.
Yeah, I mean, I think one other thing, on the non-competes, it's becoming a really hot topic, and I would say, over the last recently in this year, right? I mean, new decisions have come out in Delaware where non-competes are maybe not as enforceable as what we once thought. I think it was commonplace that you would see non-compete periods last from, anywhere between 3 to 5 years. And most of those are usually enforced, under Delaware law. But, recent Delaware holdings and findings have shown that, there maybe aren't going to be as stringent as they once were. Now, there were certain jurisdictions like California, for example, that, non-competes are generally just, not enforceable as a matter of policy. And that was really more on the employment context, right? But, there were still some, strict rules relating to the sale of a business. But we're finding that those rules relating to the sale of a business are just not, applicable these days. So, and I know Vaughn works closely with one of our experts in our office that deals with non-compete issues. So that's something that certainly should be on the front of people's minds going forward. And I would certainly recommend you talk to, legal professionals that are very well versed in the nuances of non-competes when you're entering into those transactions.
Absolutely. Well said, Steve. So the next few slides talk about LOIs in general, just sort of general at a high level. They can go into much detail as you want to or need to. There'll be obviously pushback from some of your business partners because the more detail you go, the more there is to negotiate up front. Obviously, the more detail you have up front, there's less to negotiate towards the back end. And so, on balance, I generally encourage people to, let's throw out, especially some of these, more contentious points up front and have those discussions. And then there's a few other items that are sort of key important. I'll let you guys look at those in your own. This is the specificity that I was just talking about before. The next couple slides kind of discussing whether about going non-binding versus binding. Just full stop. Always go non-binding. There are certainly reasons and considerations you might want to think, or your business partners particularly will push you. Let's do a binding letter of intent. I want to lock these guys in. It's just never a good idea, but there are certainly things to consider, and the next few slides will kind of let you, walk you through what those considerations are. So Steve, I think that's last slide. Okay, and it's making the offer really typically, and you're going to have some sort of procedure if it's an auction. You want to have a form of agreement because sometimes the terms outside of just sort of the price is really, really important, and so it's critical for someone actually to make a bid to understand what you're actually going to require for them as far as indemnification or lack thereof, et cetera. Steve, you want to talk about the definitive agreements a bit?
Yeah, absolutely. So I'm going to close this out here. I'm going to just, for a few minutes, I'm going to talk about definitive agreements and the purchase agreement particularly. So Vaughn talked about process and procedure earlier in this presentation, and that is something that we harp on as outside counsel a lot because it's critical not only to help manage cost on a transaction, but you can also lose a lot of leverage, right? A lot of strategic value and credibility if your internal processes and procedures are not tight, right? You need to be aligned not only internally, but with your external advisors. You need to know certain key information, right? And well, also you need to know how information is going to be filtered and exchanged between the parties. Is it going to go through counsel? Are there certain business folks that are going to be communicating with the other side? If that's the case, you want to make sure that you have close communication with them. And along those lines, in terms of process and procedure, it's certainly recommended that your team align on key terms and considerations for doing deals, whether that's generally for all of your deals and for the specific deal that may have been dropped on your desk. And if you're not part of the core M&A team, say that you're a specialist, that you work in labor or benefits or IP or real estate, I highly recommend getting that key critical information from your core M&A folks as soon as possible, to the extent that it's not shared. And if certain information is shared and it doesn't make quite sense to you, or if you're getting one of those LOIs that Clyde talked about and they're really high level and doesn't necessarily give you detail for purposes of what you're trying to do, then I highly recommend that you chase those folks until you get those answers. And some of those answers they may not know, right? Some of those answers may be subject to due diligence, and a determination will be made following due diligence. But those are things that you need to know from the very outset, right? And some of those things, include things that we talked about earlier, right? Like how are we valuing the business for purchase price considerations? What are some key pre-closing and post-closing activities and decisions that need to be made now, sooner rather than later? For example, what's the structure of the deal that Clyde had talked about? Are we acquiring stock? Are we acquiring assets? Are we acquiring a subset of assets from the seller? All of that will essentially determine how you're going to approach due diligence and how you're going to approach, your respective portions of the purchase agreement that you may be in charge of marking up. Things like, if you're a labor attorney, are we taking all their employees, right? Is there going to be, layoffs that are going to happen following the acquisition that would trigger some sort of warn requirement, right? right? Are we assuming debt, right? If you work in finance, are we acquiring real property? If you're a real estate attorney, what are the key IP assets that we're acquiring? Do they require any sort of consent requirements or notices to third-party licensors? Do we need to make filings with the USPTO? Are there certain services that sellers are going to need to provide to buyer post-closing? Those are usually spelled out in some sort of transition services agreement, but we need to know those sooner rather than later. And again, a lot of these determinations happen to creep up in due diligence, but sometimes our business colleagues talk about these sorts of key issues at the outset. And for whatever reason, they may just not have gotten filtered down to us. It may have slipped their mind, but these are certain things that we need to know to help do our job most effectively. Okay, so we talked about some of this stuff. We talked about precedence procedure. So let's talk a little bit about the actual definitive agreement, the purchase agreement, whether it's in the form of an asset purchase agreement or a stock purchase agreement or a merger agreement. And I just want to highlight a few points on this slide. The first point is, who are the parties, right? And that seems like that's a very high level, easy determination. But actually, you'd be surprised how many times people mess this up, right? And specifically, I'm talking about when you're on the when you're on the sell side and you have a buyer. And the buyer the deal might include some sort of, earn out or rollover consideration. And we frankly have a buyer that's a shell company that, does not have the ability to cover any sort of, obligations that are required under the purchase agreement. So sometimes you'll need some sort of parent company or guarantor to stand behind the actual buyer itself. Also, to the extent that you're a buyer and you're acquiring certain assets of a business, that business may be spread across multiple entities, right? So who are the sellers on that, on the sell side, right? Does that seller own all the assets of the business that you're acquiring such that you can operate this business day one post-acquisition? So these are critical considerations that every M&A practitioner and every specialist that does M&A transactions needs to understand, right? Particularly if I'm on the labor side, are all of my employees, are they employed by this one entity? Are they employed by separate entities? Do they use contractors? These sorts of questions, although they seem very intuitive and high level and seem very straightforward, can often be complex. The other thing that I want to highlight on this slide also is, whether or not we're going to have a simultaneous sign and closing or a signing then a deferred closing. Just because, there's going to be a lot of lead time considerations that you might have to consider if you're doing a simultaneous sign and close. If you're doing a simultaneous sign and close, if there are third-party considerations, if you need to get consents, if you need to get title, if you need to get government approvals, all those things have to happen prior to closing. Right. And if you have a signing, then a deferred closing, then there's usually a period of time where you can do all of those things. And, it's usually, obviously people want to close as soon as possible, but it's not as crucial to get those done, as of the signing because you have that pre-closing period. Form. If you have any questions, again, please feel free to answer or ask them. Otherwise, it was our pleasure to speak with you today. You can always reach out to either one of us. Our contact information will be included in the slides, and they're also included on this slide, and we would be happy to hear from you. Thank you again, and I'll turn it over to Vaughn or Clyde if you have any final words as well. Hearing none.
I'll just say thanks to everyone for joining, and we truly want to get to know you all. And if you have questions or want to talk about a prospective transaction or just anything on the corporate side, our contact info is there. The slides are available. We'd be happy to have a chat, and we look forward to it.
Thank you all for attending.
Thank you. Have a good day.